So, welcome to the first episode, or the first real episode of Benny and the Squirrel. I'm Rupert Mitchell, aka the Blind Squirrel, and I'm with Ben Bry, known as a number of things on Twitter, but capital misallocation. Benny and I first sort of became aware of each other a couple of years ago, and then, as they say, he slid into my DMs. I spent a we spent I joined him on his podcast with Nadine Turman, and well, since then we kind of chat most days. After a while, we thought that it might be worth sharing some of these daily conversations with the rest of our followers. Anyway, this is we're recording this on the evening of the 11th the 6th of November, after a pretty hairy day in markets. The plan for the future, well, I should point out that Ben is the only person in California underinvested in tech infrastructure right now. But the plan from next Sunday night is to run the show live twice a week, Thursday evening Eastern time. Sorry, Sunday evening Eastern time and Thursday evening Eastern time. But Ben, let's start. What a day! Well, we've got to start with federally guaranteed debt for OpenAI. How we left
Yeah,
there?
that CFO might lose her job over that, I would imagine. She had to issue a public apology. And of course, she did it on LinkedIn, the brown noser social media of the world. But
I'm not
I
sure I
think
buy that. I'm not sure I buy that. I think it was a deliberate trial balloon, right?
yeah, that's fine.
Because
That's
Altman did it
that's
as
what I
well.
took it as. That's what I took it as. And so, but she still has to be the one who takes a little heat. I mean, she did issue the apology, right?
And and
But
and
you're
and
probably
and
right.
and,
Well,
and Altman wrote a sort of 1,500 words, sort of Bill Ackman style text, Twitter message as well. So I mean, they're definitely on the defensive. David
oh, I didn't
Sachs,
see that. I didn't.
Dave,
I didn't see that.
David Sachs has thrown them under a bus. Trial balloons don't always work, but I mean, I think it was entirely deliberate. I mean, she's an experienced CFO. She's worked at Real Shop. She's Goldman, McKinsey, Salesforce. You know, she knew exactly
Yeah,
what she was doing. And she's also the one running the Excel spreadsheet that shows this fucking enormous gap in terms of revenues and costs. It's got to be plumbed somehow. So, I mean, failed trial balloon, we move on. In the meantime, I think it's just one step towards people doing the math when it comes to this cost and revenue mismatch. I mean,
yeah. I mean, if you think about it, right, these guys. It's actually an amazing situation. I think I tweeted something out last night. I was like, would this be the first? They're front running the bailout, basically. Like, could this be like the And look, they grew users faster than any company in history. So kudos to them. But they did everything so fast that, like, are they going to actually peak before their IPO? And look, I mean, I'm sure all your listeners and followers know, and whoever doesn't, who's my followers or new to Rupert, like Rupert ran capital markets for various major investment banks. So he knows about the IPO process. I mean, think about that. If you were back in your old seat and you have this thing coming on your desk, I mean, how do you think about it, right? Like they're already at 800 million users. Now the paid users are much smaller, but
yeah, I mean,
it's not sure that the subscription model is even the right model for them. Like it sounds like they're moving towards an ad model anyway.
yeah, it feels to me like that. I mean, the user growth, yes, headline wise is phenomenal. But if you think about what was being offered in terms of value for free when they launched ChatGPT in November of 2022, I don't think there's a precedent in history where people could get ChatGPT to put together a simple legal contract, you know, that cost the provider a few $100 and the user absolutely nothing. I mean, Web 2.0 has all been about, you know, selling dollar bills for 30 cents until a moat is created and the opportunity can be monetized. I'm not there with this because the true cost of these of LLM access right now is is way beyond the reach of 98% of the consumers right now, certainly by number, and probably over 90 by value as well. So yeah, we got this situation whereby, you know, I'm not sure. I mean, in a way, okay, so if you cast your mind back to Facebook, right? There wasn't really a revenue model or a business model yet emerging for Facebook. And it was just coming as the transition to mobile was taking place, which is really what, put the afterburners underneath it. I mean, I think we've got some more fundamental issues right now in terms of what the OpenAI, but particularly as it's not unique, right? There are, a handful of other competing foundation models out there globally, and what these guys have to offer is yes, brand recognition because they were the first to move, and chat GPT has become a verb that we all use, but they're not really offering anything that resembles to me something that looks like a moat. Anyway,
Yeah, I mean,
this whole announcement yesterday was about the greatest uniter of financial Twitter I've ever seen in my life. Literally, I couldn't use Twitter because everyone was saying exactly the same thing for about 2 hours. But some of the memes were bloody hilarious.
but I guess what I'd say is if I was them, because I mean, ultimately Google had, yeah, it was a little better search algorithm, but it gained share. But there was search, there was Lycos and Ask Jeeves, and Yahoo was obviously the big dog, and so that was also a commodity offering, right? Like, and they were like, hey, we're going to take share because everyone was sick of all the heavy, noisy newspaper-esque page when you went to yahoo.com,
Hmm.
and they found a different way that people liked better. And yeah, their algorithm for search was a little better, but I mean, I don't think the majority of users were like comparing Yahoo's search results with Google's. I think it was that it was right place, right time. It was sleek. And so, but at the end of the day, they got the lead and they kept the lead. So that was, if you were to say, on the other hand, why I would be OpenAI bull, for example, is they have the lead and they have a lot of users right now, right? And so I don't think the average
Yeah,
guy is
I'm not doubting that at all, Ben. What I'm simply saying is that the path to monetization of that competitive position is not clear to me at a reasonable.
no, it's most definitely going to be in ads. As
Yeah.
we talked about when I said, hey, one of the parts of the short meta thesis, a couple months ago, which hasn't even started to play out yet, was that okay, well, these guys are going to enter the digital ad space. Well, that's a new competitor who has a lot of users who are using a lot of time, and they hired away Meta's head of ads, and they hired like a lot of people, and they're talking about they're going to do erotica. It's like just be a man and say porn, right? And then so it's clear that that's the way they're going to go. They're like, oh, we'll customize it for you, travel plans. Like they're just going to be internet 3.0 more or less. Like there's nothing, because the model itself, right? So a token based auto-regressive model is fundamentally limited in its scaling ability because each token has such little information density. So it's like 15 bits, 18 bits, 20 bits per, and so you need the vocabulary of the model to scale. And the only way to do that then would be exactly what they're complaining about, which is more compute, more data centers, more physical resources. So they're running into the constraints of capital and physical or physics, actually just say physics. And so that's why it's like interesting. I sent you a paper a couple days ago, and one of my buddies, Sashin's working on a startup where they're going to be able to start bundling tokens. And so that will be the next generation of this. But in the meantime, it's pretty clear that they're running up into constraints.
Yeah.
Like him complaining, him putting a weather balloon of government guarantees of, hey, we need more compute. Jensen clearly, is the biggest winner of all this. And he's out there bitching to the Financial Times yesterday. Oh, China's going to win the AI race because we're not
Hmm.
going to spend all of everybody's money,
On
so
me.
that I haven't. Yeah. So I think basically the next
Okay.
evolution of these.
Well, I agree with all of this, and I think you're absolutely right in terms of the tech roadmap. But where does that leave us with markets that we can trade right now? Because yeah, we had a bit of a rocky day today, but we would do one. We're still inches away from all-time highs. But you had some interesting charts, which definitely demonstrate sort of some weakness under the hood. I liked I liked the Oracle chart that you shared with me
Yeah,
this
let's
morning.
let's
Why don't
pull
we
that
start
up
with
real
that?
quick. Here, I'll share that. So, this is so Oracle comes out, Larry Ellison's like 82 years old, right? And he's kind of like, whatever, we're gonna go full retard. And when you think about or you compare, and I think Rupert, I've sent this to you before, the trailing 12-month cash flow from operations, the next 12-month cash flow from operations, trailing 12-month capex, next 12 month, and then what they pay out to stock-based compensation and repurchases and dividends. You can see that Oracle's clearly the weak player here, plus not the experience in it. So when you look at this chart, and I got to give my partner Nadine a little credit because I was thinking about shorting it before this announcement, and she's like, just wait off. And then I shorted it after the announcement, which is the better time to short it. But
Indeed.
we get this 40% move up, right?
Yeah.
And we now have fully round tripped it. Today was the official,
Anniversary of the
basically.
round trip. But I think also point out the black line there is Oracle's CDS. This has been really expensive in terms of its cost of debt.
Well, that's the kind of more important thing. So, like, to
Yeah.
go back to what I was saying about these models are hitting their foundational limits from just an architecture standpoint, but also that means then they're now starting to hit their capital limits because the only way to continue to scale them is more and more capital, which I think you and I, you've been around the game longer than I have, but like everyone who's an old school guy is like their eyes are popping out of their head with the capital like commitments, and like this whole thing is, it feels very banana land. And so you see like this gets announced, Oracle CDS was kind of trading between 40 45, and CDS isn't as liquid as it used to be, so just think about it like that. Well, now it's in the
It's almost a
80 to
double.
88 range. And for all of you who don't trade credit default swaps or don't trade credit, you have to understand a 40 basis point move in an IG in a non-market crash, right? So like in the spring, everybody's spreads were going out together, right? Right now, spreads are going up a little bit, but nothing that would justify something like this. So I think when you think
Yeah,
about.
there's one thing, and I think it was our mutual friend Larry that pointed this out. I saw the other day in IG land, the impact of these big bond issuances by Meta and others to finance the SPVs, the data center SPVs, has actually created a bit of dislocation in IG credit land. I mean, if you look at LQD, the IG bond ETF, that's actually sold off, quite significantly in the last week or so. Just as existing IG paper needs to be sold down to make room for this 30 billion issuance by Meta. So, I mean, I think we do need to overlay that a little bit, but there's no doubt that the cost the
Sure, I mean,
cost
like
of debt
I'll put that up.
capital for the cost of debt capital for Oracle, has moved appreciably since the announcement that it did so much of a boost to its equity, which has now been round
Right.
trip.
And so here we go. This is just the 5-year on the run CDS for CDX IG
IG, yeah,
investment grade. this don't worry about this. This is when it rolled. It rolled at the end of September.
Yeah.
So this think about this as like it didn't happen, right? Like,
Hmm.
but yeah, we're up a little bit. Like this is kind of when last week Meta came to market, and then Google was, or Alphabet or whatever was on Monday. So yeah, we've gotten, which by the way, 3 basis. That's why I say 40 basis points in Oracle is an enormous move. Again, for anyone who doesn't trade credit, that's like a 25%, 30% decline in equity. Which by the way
Yeah.
was how much Oracle's equity declined. Right, it's down 30%. And so, but yeah, you got 3 or 4 bips, which is like that's significant, but it's not enormous, to like the point of it's crazy, but it's we're in a situation where I'll stop sharing that for a second, where
Yeah. I
we
think it'd
now
be
have.
actually. I think it'd be worth actually calling up, Ben, the high yield OAS as well, because the context of a move like Oracle's, right, also needs to be shown against the backdrop of what's been happening in terms of spread compression in high yield. It's been a one-way bet lower for most of the past 12 months. So for a big name like that to blow out is a big deal to my mind.
Yeah, I mean, here we'll go back to it real quick. You can see what he's talking about, like 22, we have
That's
this
IG.
move out. What?
That's IG, right?
Yeah, IG. But
Yeah.
let's remember, high yield's not a big deal at all. High yield's
No,
the
it's
the
not.
kite at the end. Like IG is what matters. And I had a guy, just as an aside for people. I, you can do okay over time if you capitalize S&P earnings by the BAA or the triple B IG yield, the inverse of it, and use that as
Yeah.
your multiple. Over time, that can be a good guidepost of what the multiple should be for the market. So, when we think about how ridiculous, like, okay, so 5-year
So
paper
just
is
for
at.
everyone, so that's it's just the reciprocal. It's one divided by the high yield, right?
Yeah, and this is
Translation.
just the spread. Just remember, this is just the
Yeah.
spread. This is isolating for the change, like, because you're trying to say, okay, what is the spread over the base rate, which is the government, policy rates. And so for high yield, most of it's on 5-year.
Yeah.
And so 5 years paper is, I don't know, 360, 365, something like that. And this is now, basically 53, 54. So you're talking about like 415, 420. So, it's close to what the market's trading at, right? Like 4% would be a 25 times multiple,
Yeah.
5% would be 20. Market's trading in, depending on your earnings number and all that stuff, it's between 20 and 25, right? Like I don't want to be like getting into the game of what's so precise, but it's in that range and it's very similar. So that's a good way to think about it. But like you can see what Rupert was talking about is like 22 was obviously a tough year between the budget deficit coming down, rates rising, and oil spike, and geopolitical concerns, risk premiums rising. It was, naturally you got a big spike. But since then, we go from 110, 115, or, let's just say right here, 100 to 110, right down to the ground. And then we got a spike. But then what's
Yeah. The
amazing, and
Liberation
what
Day
I got
spike.
wrong this year, because I caught on one of my funds where we were short this stuff, we caught this, but then we got back involved here. And this move from here to, I guess, even still recently has been painful. Like, this is not normal to like have a spike and then go back to where you're at, like
Yeah.
back
I
to
mean,
the tight.
I've got a theory. I've got a theory about this. I mean, ultimately the impact of private credit has had, profound implications for the public bond market. In that, well, there are two things going on. First of all, there's not enough, public paper these days. Once you deduct the share, the increasing share that's going to the world of the shadow banks, to go around against benchmark money, right? So that's the sort of relentless spread compression you're seeing. And then also in high yield land, and we've talked about this a couple of times, I've certainly written about it as well. you've got this situation where actually private credit has been taking away some of the worst credits that used to go into the public bond market. So you've actually got some high grading of high yield that's been going on over the course of the last 2 to 3 years. And so going back to your spike point that we saw around quote unquote Liberation Day, my view certainly is that a classic high yield spread blowout is not going to be as spectacular as we might have seen in yesteryear. One, because I think the intervention will come pretty quickly from the Fed. But two, you've just got a better quality bunch of issuers that are quote unquote high yield these days. And certainly what I've written about a lot is that when that spike comes, maybe it comes to sort of 700, 800 over, but you want to do a 180 at that point. Lock in double digit yields to maturity on that high yield paper, because that's going to be pretty good to own at that point in time.
Yeah, I so one of my I'm a contributor at Wall Street Beats, and one of our subscribers was is a high yield guy, and I started to talk to him. I talked to him on Bloomberg a lot, and running up into the liberation, he said to me, he said, "Look, there's going to be a wall of demand at 500 basis points," and that was literally the top tick, right, for high
Yeah,
yield. That was a top tick, and I should have listened to that guy because that was it, and then it came down. And so I think that that was 500 on this higher base rate. And so part of my thesis is, as Rupert knows, is that I think rates are going lower. So credit and base rates, there's an interplay, right? So if base rates go lower, and base rates meaning treasury rate, like, from the Fed policy rate all the way out the curve. And so if the base rates come down, well, if you're a bank or a lender or private credit or Rupert, for what that matter, you're really targeting your all-in yield. So
absolutely.
all-in yield is what matters. Like, hey, what am I actually getting? So when you have all-in yield at 7.5%, which is roughly where high yield's been, most guys are pretty good with that in a stable environment. If things get dicey, they're going to take that up to 10%, maybe 11%, which is where kind of private credit kind of plays at. But so the thing is like, if the base rate, if the government's not paying that interest, right? So the government's saying, hey, we're not paying interest anymore. Well, you kind of still want that yield. And so the spread kind of naturally widens as the base rate drops, is kind of the dynamic that I see playing out. So that
Yeah, I think
500
that's right.
could now be 700, 800, basically.
I think that's right. I also think where we are now, quite an interesting point for, you know, segueing into, well, we talked about the policy uncertainty created around tariffs on Liberation Day. We've obviously got the Supreme Court ruling coming up, and I think that, you know, we should talk about what this means for rates markets, for credit markets, and equity markets, because I think there are a lot of moving parts here. I mean, do you want me to start?
Yeah, go ahead. You
My
rock it
my.
off.
I mean, I'm always more of a Bond bear than you, and
No, that's not
that's
true.
that.
I'm very fine being a bond bearer also. That's
No, I know, but you've definitely been more in the bullish camp this year. My issue with,
you mean
if
the right camp. The right camp is what you meant.
absolutely. So my view my view around this ruling is pretty clear. Is that if if SCOTUS rejects the IEPA tariffs, right, you've got another further acceleration in policy uncertainty, because you know one thing's certain: when policy uncertainty goes up, C-suite decision making grinds to a halt, right? Does this slow down growth? Yeah, probably. Bond bullish, right? What if Trump ignores the Supreme Court ruling? I mean, do we have a constitutional chaos sort of situation on our hands? You know, what if these already paid tariffs need to be refunded, right? Is this is a a deficit expansion that would, you know, surely point to some kind of term premium expansion, right? Um, I don't know. And if this puts longer term yields back up, through 5, is that going to be enough to, sucker punch the stocks? Now, my view is that, the stocks will have a knee-jerk reaction to the cancellation of the tariffs, which I think will be the wrong move. I think the stocks will leap up on the thought of tariff cancellation, but I think that would be the move to fade. But I don't know. I think it's pretty hard to trade.
So my view is this: I bought a little tariff basket a couple days ago, and I did add our stock that both Rupert and I got wrong this year, Goodyear Tire. Just full disclosure, and it actually had a decent print, but the I added a little bit of that for a hedge, not too much. And I'm massively long bonds, just so everyone knows. And I think this is a total nothing burger. I think it's actually worse for. I think you're right about risk premium would go up, but like I don't think 200 billion or 150 billion or whatever is gonna. It's a drop in the bucket for the bond market.
I,
Okay, and so let me
I'm
just keep
talking
going.
I'm talking more about, ultimately, and this is something that Julian Brigden's always very strong on, that, Fortune 500 companies are managed for the stock price, right? And the moment that C-suite executives see policy uncertainty, right, they sit on their hands, right, because they think that, we need to stop investing and focus on the buyback because we need to keep that stock price high for our RSUs. And if Trump is ruled against on these tariffs, he's going to start looking at all other forms of, one, whether it's the other codes where he does have a mandate to impose tariffs under the law,
Or
or as
or
you were mentioning before the call, you call it,
or
Benny.
what people were talking about in the beginning of the year, and I was talking to a buddy of mine on the phone earlier, and he had a guy in his office who brought this back up, and I thought it was a good thing because I hadn't thought about this in a while, which is the 899, you know, taxing foreign capital, right? And Michael Pettis and my buddy Hugh Hendry have been big proponents of this idea of like, look, I'm a hedge fund guy and I understand asset markets. Like, why do you pay a premium to have your capital with a good hedge fund manager or a good private Mark Rowan, Apollo, or wherever? Like a guy who's a good steward of capital. Why do you pay a premium for that? You pay a premium because they produce results, right? They treat your capital well. So you could make an argument that on a global scale, again, 35. Let me see if I can show this real quick. Just window here. Yeah, here it is. Look at this. I'll only keep it quick. 35 trillion of foreign capital is the United States. 55% is equities, 45% is bonds, 26, 28. And so if you're thinking about it, like you're like, well, why is that? Why is so much money in the US and they're not in Rupert's home country of the UK or the England? Sorry.
No,
And
the UK, England's not a sovereign nation. The
no, I
United
just know
Kingdom
my
is.
buddy. I know my buddy Tom Roderick would just he's a Wales guy, Welsh guys and
Well,
English
I'm a
guys,
Scot. I'm a Scot. Don't accuse
and
me of being
Hughes
English.
is Scott. So I got lots of like I mingle with lots of financial guys from the island. Let's put it that way. But anyway, the point
So
is that
okay, so let's talk about that. I mean, I think there are parts in the past where that kind of surcharge on foreign capital could have been got away with. I think you do it now in the context of what's been going on with this administration. I think foreign capital votes with its feet fast.
so I hear you, but here's the problem with that. So it's natural to be like, okay, hey, I'm invested in this, and this hedge fund manager is off at Burning Man with DJ Dave from Goldman Sachs, and they're acting the fool, all this shit. And the reality is, where are you? See, I think that when I talk to a lot of my buddies who are wealth managers or just rich guys who like don't want to realize their capital gains on Nvidia or any of these companies, is that you got to pay the tax and then you got to do something with it. right? So
Hmm.
if you're going to sell in the US and you're a foreigner, you don't have the tax consideration. So that's one thing that's not there. But then you got to be like, okay, where am I going to invest? And I don't know. We'll see. I mean, I have liked the
Listen,
Japanese market.
I don't think we're talking about a 100% exit, but we're talking about a situation where foreign capital can no longer be so overweight as it has been in the past. And I think to be honest, if they try to pull 899, it would be a triple yazoo for weeks.
I mean, let's go back to this real quick. Then, since we're talking about this, let's go back and look at this same chart I was just showing, and look at it when Trump one came around. All right, so here we are. Right, so Trump got elected here, so it kind of down a little bit, and then I don't know, it didn't move that much.
No,
If
no one
anything,
was talking
equities
about
went up.
899. I mean, I don't think you can make the
No, the
analogy.
899 is what we're talking about, and I agree. So back to what I'm saying. Let's now talk about what I think the trade is for that. Like, if he does this, as because look, I do think the government needs to tax foreigners. Like, I think that the United States has a budget problem, and it's very clear now that the government shut down for, like, I don't know, day 36, 37, whatever it is now, that people
Hey, just
are
a
not, they
suggestion.
kind of think,
How about the Mag 7 started paying tax?
well, then it's going to hurt your UK as well. Those Irish
Mhm.
boys are not going to be happy when all that capital that's sitting there from that
Once
tax
again,
loophole.
a
Look, if they were
geography
serious, they
lesson,
would
Benny.
take that
Ireland's a
tax
separate
loophole
country.
away. What?
But geography lesson again. Ireland's a separate country.
Okay, I know. Just like, well, Wales is. I'm just saying, okay,
No. Ireland
the
really is.
greater,
It's not part of
the
it.
greater, the greater island,
Well,
whatever.
over there. You mean over there, other side of the pond thing. Yeah.
Yeah.
Listen. One of the things
See,
I promised.
I'm touching a nerve right here.
One of the
No,
things I
let me
promised
finish
when we
this.
start. Wait, hang on. I'm stopping you now. One of the things I promised when we talked about this, you and I, our average conversation when we talk pretty much every other day is about 90 minutes. I look at, oh my God. But when we do these shows, we're going to keep it to half an hour. And just as a
This is
reminder,
the first one, so
yeah,
let's keep it going.
okay, okay. But just to warn people so that you're not dialing into another sort of
No.
Huberman type
I
show.
think that's right. I
The
think it's
will be
the first one.
half an hour.
Yeah. Well, look, again, like, it's targeted for a half hour. It's plus or minus 10 minutes, usually more on the plus side than the minus side. But like, the bottom line is that basically the 899 would scare people. Rupert's completely correct on that, and so I think that bond market, yeah, it get hit some. I think the equity market definitely would get hit because that's much more like, a bond is a much more serious security than an equity at the end of the day, right? Like,
Hmm.
it's going to par, the government's going to pay it back. Sure, you could get 20, 30 basis point move, which, as a guy who owns a lot of bonds, it just took a 15 basis point hit the last couple days until today. It's not fun if you own duration, but like, I just would share this. This was my idea, and Rupert can tell you how to do this. But this is the 3 month Japanese yen, dollar yen, 25 delta butterfly, which is basically just a pure, like, visualization of volatility, implied
FX
volatility
volatility.
price,
Yeah.
like, for this cross rate. It's a mean reverting series, as you can see. Spikes down, spikes up, whatever. So we're pretty close to the low. We're not at the low. I'd say we're probably 25 percentile. But what Ruben and I are talking about here, and I'm going to come back, we'll stop sharing. What we're talking about is basically the idea that if foreigners were to get scared, it doesn't necessarily mean they have to pull their capital. The market will try to front run it, in
Hmm.
essence. And so you could see FX vol pop. And FX vol is a beautiful thing. And I don't know if everybody can trade FX vol or even knows what a variance
Well,
swap is.
you can. I mean, ultimately, I mean, it's more complex, stripping it down to its purest expression. But there's an obvious directional move here, right? You can own yen calls via the CME
Yeah, I think
futures,
Yang calls gets
6J.
you the
You
vol.
can. FX, and you're going to get the vol and the direction. It's a sort of double. It's a double kicker.
Yeah, I think yen calls. So like again, full disclosure, I own 200 digitals, one touch on the yen, but I
At what
also I
strike?
was
At what strike?
200, 200.
Oh, sorry, sorry. I thought you were
And
talking
and
quantity.
and I'm thinking about buying the
Okay, but how
110
how far
Go.
out is that? How far out that? I mean, obviously, 200's a big
Uh
move, right?
June 2027.
Okay.
So a ways out. But I also think, and I've had this conversation, it's like I'm a dollar bull, but like without, I don't want to diverge into why I'm a dollar bull, but like this is a negative dollar event that no one's talking about. And I think that's like worthwhile for people to like rethink about the 899 and think about Trump and who he is. And he's going to go to his playbook or his options or whatever you want
His
to call it
menu. Yeah.
and think, what can I do? And the reality is the budget needs capital from foreigners. So this is the easiest second, like, yeah, they can do sectoral tariffs and all these other kind of tariffs, but it takes time, and rightfully so. There's processes to do
And
that,
and and
and
we
Trump and
we
those guys were.
we've got two economic advisors in the White House in the form of Besant and Mirren that have actively promoted this idea of a sort of Tobin tax on foreigners, right, of sorts. And so he's definitely going to be getting a version of this in his ear, right?
Yeah, well, no, I mean, again, on this conversation I had earlier, it's already written out. Like they had bills already. Like this
Yeah.
law is already
No, I
written.
remember.
This is ready to
It
go.
was a it was
This
it
can
was a
be rolled
focus
out
for about
fast.
it was a focus for about 5 minutes at the beginning of the year, and then everyone moved on to
No,
the
couple
to the
months, couple
to the
months. It was a
penguins.
couple
Yeah.
months, and they have the law written already, so they don't need to like go make some young legal guys like go get slaved away and put in a room for a weekend. But
Hey, come on. We know they use ChatGPT.
anyway, we're not going back to that. Anyway, so the point is, this is a trade that is a convex trade that, forget about what happens. It's priced very much so that you're paying nothing. It's basically a 0 to 3 delta option, right? You know what I mean? Like out of the money dollar yen, out of the money, yen dollar vol, out of the money, deep out of the money equity like puts, which are getting a little more expensive. But even despite the market kind of being wobbly recently, vol staying where it is.
I tell you what, the right tail is just so much more expensive. I was just playing around with pricing a
Incredibly.
sort of elongated strangle on Meta, right? You know, basically the right tail, if you like, the digital god option on Meta is so expensive right now. There's no point owning it, to my mind. I think you just own the left tail on this one.
Look, I mean, I'll tell you what I did today. I have a sheet on my Bloomberg Launchpad, and I screen for all the option structure, and the Bitcoin sensitive names have this insane call skew. And I know it's because, and we had Nadine and I had this guy Ruslan on our podcast like last October, and he was running a Bitcoin mining operation, and then he was transitioning into power for inference
Compute.
and training,
Yeah.
right? And so I've been aware of this for a while. To be fair, I didn't buy these stocks. Should have done that after that podcast. To be fair, like these things have been absolute animals. But IREN, I sold the 81 strike call for tomorrow. Now they had earnings tonight, so it's amped up a little bit. But you can go out and all these things. The call skew is
What's
insane.
what spot? What spot? Just so everyone knows. Not everyone.
81 strike. It went out. I shorted it when it was at
What was
69,
spot reference? So a spot reference was you sold the 81.
$69,
Okay.
and I shorted it for $1.10. And,
Okay.
okay, and
But
then
that's a
basically
$12 move that you got paid for writing.
15, 16%. That's a
Yeah.
220 vol. It's
Yeah.
like, again, I'm a long vol guy. I have a long vol fund. I always will sell 220 vol. The only time I've ever in my life bought 180 plus vol, one time, and that was when oil was going to zero and I knew it was going to zero. So I bought the $10 puts in April of 2020 because my exchange told me we changed the rules and the structure to allow oil to trade negative. And I was like, why would you do that? It must be getting ready to trade negative. And like that was my only insight. I knew it was
which
oversupplied, but like,
which which brings us back to trial balloons, which is where we started, right? With OpenAI. I mean, you know, never ever ignore a trial balloon. Right now, it was pretty
totally agree.
comprehensively. It was never compre. It was completely comprehensively shot down, but it's there, and its adjustment effect on the Overton window has to be part of our reality now, right? Keep a
And,
close eye on this
and think
space.
about it. Like Trump and these guys do it. Everyone does it. Like I think the more and look, obviously some market participants are very attuned to it, and like you need to be more and more attuned to it because that's how the world works. These trial balloons are like just an insight to how they're thinking, and they want to see what the reaction is. And again, the trial balloon yesterday of OpenAI saying government guarantees. Like I almost last night was going to do a CapCut video of everybody's. Like I was just kept screenshotting everybody's Twitter. I was going to be like put some kind of Led Zeppelin behind it and just like boom, boom, and it was so ubiquitous negative. It was insane.
I don't know. It was a true uniter. Anyway, Benny, we've been 40 minutes. We're gonna wrap it there. As ever, as discussed, the plan is to come out on Sunday evenings Eastern time and Thursday evenings Eastern time, quite a bit after the close, kind of cocktail hour for anyone on the East Coast, a bit earlier for those on the West, and morning time in Asia, because we will try and talk about what's going on in this part of the world, and we haven't even started on China. That'll be a topic for Sunday, I think.
And just that if you made it to the end here and you're still listening, we're gonna talk about capital markets. We'll compete on Sunday nights. It's hard to compete with the NFL. Rupert doesn't understand that 6 p.m. time slot in America as a that, or it's
I'm
9
go
p.m.
I'm going for the split screen audience because you guys have a ton of ads when you're watching football.
It's true. It's true. But and then we're gonna have a bunch of our friends and guests, the good people on here that we'll bring on either on the live show or we'll publish it as a side product. But should be fun. Rupert and I are good buds, so and more importantly, the market's super interesting. So it's fun to have a guy in the east, guy in the west. I guess as west as you can get almost now. I can't even believe I live in California, but whatever. And it should be fun.
Perfect. Well, listen, see you guys on Sunday night. Benny and the Squirrel out.
Benny and the Squirrel.